Hello, this is Alex from DiamondArm. Hope you're having a great day. First off, read this disclaimer carefully. In this video, we will look at a very interesting ETF for these very turbulent times in the market, and that is the HDGE Advisor Shares Ranger Equity Bear ETF. So this is an ETF that will go up when the market goes down. So it is bearish. So let's jump into the charts. So the data points here are weekly data points. So each data point represents 1 week. And you can see that it's been around since May 2014. Within that time frame, this ETF has plunged minus 43-ish%. However, a lot of this, was through a bull market. So if we zoom in, we can see that during this turmoil in the markets, this ETF has actually risen quite substantially. So let's actually do some measurements from this low to this recent high. That's an almost 40% rally. So that's the great thing about this ETF. It will go up when the market goes down. What you can see here in the lowest part of this screen, this is a statistical correlation between the S&P 500 and this ETF, and you can see that the correlation here is minus 0.95, which means that there's a negative 95% correlation between this ETF and the S&P 500. That's great, because it means that in the vast majority of instances, when the S&P 500 goes up, this one will go down and vice versa. So yeah, this is an interesting product. However, during a bull market, obviously you do not want to have exposure to this one, since it's not going to perform well. The big question is that we have recently seen the S&P 500 plunge very dramatically. So let's look at the S&P 500, and then we will look a bit more at the ETF, what it contains. So you can see that, this is S&P 500, and we have seen a total collapse. You could certainly make the case that this recent collapse is historically just abnormal. So this correction here was far more gradual, this one as well. Even if we go way back here to the financial crisis, let's actually do that just for some context. So this is the financial crisis. It was pretty dramatic. This is the phase where there was total panic in the market, but look at this phase and compare it to this. This is just way worse. It is so extremely bearish at this point that you could make a strong case that we are expecting to see just some kind of rally, like we saw during the housing bubble, that bear market. Also during the dot-com bubble as well, even though the market lost a lot. Also during the Great Recession before World War II. The markets lost a lot, but we did see, even though we were going down, there were rallies every now and then. The RSI is currently, it's 24 here. That's really low. Let's actually get this a bit like this, like that. So 24 is just abnormally low, and if we go way back in history, let's actually see whether there is actually a precedence for going that far down. Okay, you have to go to the panic phase in the later part of that housing bubble. The ultimate lowest RSI here on the weeklies was here you have some pretty extreme numbers. So here you have 16. That's an extremely low RSI, but you have to go all the way back there. Here you have the dot-com bubble. So here you have a very low number, like that, 22. That's pretty darn low. We got 21-ish. So this is just a very abnormal situation. However, the probability of this correcting and heading, into another, just continuing this preceding bull market, that's very, very unlikely. It's like a V-shaped recovery. It would just be really it would not be what we expect at this point. Because what happened today is that the Federal Reserve, they were really making big promises of just pouring money into the market to prevent total implosion. But even though so here you can see what the Fed did. So less than an hour after the Fed announced the massive expansion to its repo facilities, adding one $500 billion 3-month repo today, following by an identical repo tomorrow, and subsequently weekly $500 billion repos. In addition to officially expanding not QE to a coupon monetizing QE5, many are asking if the Fed applied the wrong medicine for 2 reasons. So yeah, it simply didn't work. So let's look a bit more in detail at this ETF, the Ranger Equity Bear ETF that we saw first. So, hedge attempts to achieve positive returns by shorting US listed companies believed to have low earnings quality or use aggressive accounting policies. So, broadly speaking, this strategy, it should be able to make money during a bull market, even during a bull market, because there will of course be stocks that goes down during a bull market, but the hedge fund managers simply have not. The performance spoke for itself. During the bull market, the hedge ETF did not. It was not a profitable investment. However, during a bear market, as we've seen recently, it performs well. Expense ratio, it's pricey, it's above 3%, but that is to be expected since there's not much competition in this space. But I would certainly expect to see a significant number of new bearish ETFs come onto the market, because there's now a demand for those kinds of ETFs. Assets under management is $145 million US dollars. That's definitively expected to increase because people will flock to these kinds of ETFs during a crisis. It's just that this is probably not something many are aware of. So let's look at holdings. We don't have information of holdings here. No. So that's the thing here. Okay, the market it's in a total mess at this point. There is utterly unprecedented panic. It has to do with many factors. There's really, of course, the virus, outbreak is the straw that broke the camel's back. It was that one factor, that extra factor, that simply was too much for the market to handle, and we are seeing it unravel. But it is very important to be aware that there are other factors at play. The bull market was very old, tons of debt, and the Federal Reserve is not helping out with that. It doesn't really just printing money, just making it magically appear. It doesn't really solve the underlying issue. You of course have the trade wars. That's a very important factor. And there's also many other kinds of uncertainties. So I do certainly expect a counter rally to happen in the not too distant future, simply because the panic has been so extreme. The bears are expected to take some profits as well. But looking further into the future, it's extremely likely that we will see a full bore bear market. It would take extraordinarily good news if for this market to just make a full speedy recovery. So whatever you do, of course, you want to let the trend be your friend, and one of the ways to have a nice trend financial product during a bear market would be to look at the hedge ETF. But even if you hold a product like that, you of course need to study how it behaves, Always let the trend be your friend.